Cori Timmons is a member of the McDougall Wealth Management team with National Bank Financial. She is a certified financial planner, chartered financial consultant, and chartered life underwriter. On our team, she plays a vital role in ensuring the estate and legacy plans are secure while also protecting the financial security of your loved ones.
Thanks, Sam. Hi, my name is Cori Timmons. Thank you for attending our last session today. I'm working on the module Succession Planning for Transition of the Family Farm, the Right Plan. So again, Sam mentioned my associate Dave Zimmel is unable to join us today. My role is I work with the estate, retirement income, succession planning, and I'm also an insurance specialist. When you think of retirement income planning, what comes to mind to most people are investments, rates of return, and market corrections. At McDougall, we do a little bit more than that. Well, actually, we go a lot deeper than that. You know, what we try to do is look at what happens in retirement. What happens if one spouse or partner requires long-term care? What if dementia, cancer, any of those ailments enters the picture? What happens when the first spouse passes away? What happens if one of our kids have a special need child and they need our help? Those are all of the realities in retirement income and estate planning that are just as relevant as rates of returns, investments, and market downturns. So the farm estate planning is different. You know, it's more than a business, it's a way of life. There's a lot of emotion attached to the family farm. And as you've heard from the last couple of sections, there's a lot of rules. It's actually quite complex. A couple of fun facts, I thought, you know, there are over 17,500 farm families in Canada. That was as of 2018. And farms control over $50 billion of farm assets that are going to change hands over the next 10 years. Because the majority of farmers are going to turn age 65 in the next decade. This is a bizarre phenomena. It's the greatest transition that we've ever seen in agriculture. And farmers feel very unprepared to meet the challenges. The reality is young people can go to University of Alberta, Olds College, they can get an education in farming, but once you've got that education, unless you belong to a farming family, it's almost impossible to get into the industry. So startup and transition of new farms must be carefully planned and executed. So again, what next? A lot of information has been thrown at us the past couple of days, and I have to admit, I live on a farm, and if I didn't work in the industry, I'd be quite overwhelmed. I don't know what I would do. Our land has special meaning for our kids. The property doesn't qualify for a rollover under the complex rules that you heard about. Taxes have to be paid, and there just isn't enough land to make it viable for more than one child. So it is overwhelming. What do you do? Where do you go? So McDougall has developed a wealth management process that creates a structure for helping families plan for retirement and the ultimate transition of the family farm. What we do is we try to help families create a map, and your map is going to be different than other families. We have to find out what's important to you and your family, and what do you worry about? Second, it takes time and effort to just sit down, step back, and figure out exactly where you stand right now. Where are you now? And next step is, where do you want to go? Do you want to stay on the farm? Does the farm have to help you subsidize your retirement income? Do you want to go to a foreign country? How will you get there? So creating that map is the next important step. So let's take a step back and look at the family that Edith was talking about a couple of minutes ago. We have Bob. Bob's a client. He's 65 years old. He lost his wife a couple of years ago to cancer, and he lives on a farm. And the farm came from his wife's family. It was passed down from the family since 1904. They've actually got 6 quarters of land. And when they were married, the land was worth $175,000. Fast forward today, the land and the farm operation is worth over $5.5 million. Bob has a small home on the home quarter, and his daughter Sue and her family, they built a nice home on the same quarter. They're in the same yard. They've got 3 kids. Bob has some savings. He's got a nurse's pension that his wife had while she was working. That's going to pay him $2,800 a month. So he's got that to rely on. Now that he's 65, he's also got old age security. As long as his taxable income doesn't exceed $79,000, he'll be able to keep that. He'll be eligible for a Canada Pension Plan. The maximum is $1,174. Bob is going to be entitled to almost the full amount there. Bob's got a tax-free savings account with McDougall. He's got $250,000 in RSPs and another $350,000 in savings. So when Bob retires, the farm won't be able to pay him much because Sue and her husband had to hire a hired hand to help with the work that Bob won't be doing. So Bob's on his own. So what's important to the family? You know, Bob's thrilled that his daughter Sue and her husband and kids are able to stay on the farm. You know, he felt a huge responsibility to keep the land in the family. His son went to university. He's a successful civil engineer. It's very unlikely that he'll come back to the farm. He's single. He's got a nice girlfriend, very successful. But what keeps Bob up at night is he knows that by transferring, giving, selling the farm to Sue, he won't be able to be fair to his son. It won't be equal. He knows that his daughter will be getting more than his son. And again, that weighs very heavily on him. So what is fair? What is equal? How does that work? Huge pressure, huge pressure. So Bob has been working with us at McDougall for the last 5 years, and we've just started to explore some of the transition options for him. So the process is at McDougall, first of all, we try to collect the facts, and that can be done as early as your 30s, 40s, 50s. Get to know you, what's important to you, what's the approximate value of your farm, what's the original cost, how is the land owned? Is it corporately owned? Is it personally owned? Was some of it brought over from original family members? Did you buy additional land along the way? What's the structure of that? Is there any debt? Do you have any investments? Is there any life insurance, critical illness insurance? Exactly what do you have? So that's gathering the facts. So after we know exactly where you stand, we take a look at what the critical issues are. What are the important issues to you and your family? The financial decisions that you make are intertwined with the emotional, personal, family decisions that you make. So the starting point for Bob was we needed to estimate what his after-tax income needs were going to be in retirement. You know, where did Bob want to live? Does he want to stay on the farm? Bob's originally from New Brunswick. He indicated that he'd like to go back and spend some time with his family there. He hasn't been able to go back over the years, and he'd really like to do that. He'd like to travel a little bit. We identified that the farm can't afford to pay him anything in retirement. Some family farms can, some can't. And again, the reality in retirement is one of the spouses will probably pass away first. Involuntary separation is a huge pressure. You know, do one of you have to go into long-term care? How do we manage that? When we get the call that something happened, you know, it's always bad news, but in the background, we'd like to know, okay, it's okay, we've got it covered. It's a terrible time, but we'll help you through it. Once we know what the critical issues are and the dynamics of your family are, we start to set goals. When do you want to retire? Which child will get the farm? Does the child pay for any of the farm? What are the goals? What are the goals? How do we facilitate them? And the next step is become familiar with the estate planning tools. Ian made a very good comment. today. He said, it's important to be aware of the financial tools, the estate planning tools, but we don't have to understand them to the deep degree that we don't have to understand them to the greatest degree. So the critical issues are, it's not about being reactive, it's about being very planful. So when we go back to Bob, we can see that his Canada pension plan, he'll apply for it this year, he'll have $1,176. His old age security will be $614. His pension is $2,800. The RSPs will create an income. His savings will be there. Are there any corporate savings? And then healthcare for him. What will happen if anything happens to him? So control is the next issue. This is a very difficult area of discussion as well. Do you transfer the farm during your lifetime? Do you put it in your will? Do you gradually transition it? The 3 Ds hover over every decision, and the 3 Ds are divorce. It's difficult to pass land or a farm to a child if the marriage isn't stable, if there could potentially be a divorce, death of a child, premature death of a child, and disability of you and your child. So control is a very important hurdle to get over. And then finally, fair and equitable. So the goals, again, it's not about being reactive, it's about being proactive. We want to separate the needs from the wants. We often find that there are a lot of things that people would like to have, but our resources are limited. So what do we need? What's most important? And how do we prioritize it? The second thing relates back to what Edith was talking about. We have to make sure that the agreement is bankable or realistic. Sometimes we have to borrow money. One of the other things that we often do is we create life insurance benefits in an estate to create liquidity. And again, when we're starting to lay out all of these options and become familiar with the estate planning tools, these are just preliminary decisions. These are discussions, things can be changed, things evolve. We can guarantee you that things will change. But again, it's all preliminary. Trade-offs have to be made, and you know, when Reg was speaking yesterday, he mentioned that there's an abundance of emotions. And you know, we all have to keep level heads when dealing with the farm and look at what our choices are. So some of the tools with estate planning, I think we're one more slide ahead, Sam. Become familiar with the estate planning tools.
Sorry.
Some of the tools that are good to be aware of, but you don't have to understand them deeply, are business arrangements, shareholders agreements, vendor financing, life interests. Life interests come into play where, you know, in Bob's case, if Bob happens to remarry and brings a new wife onto the farm, how do we make sure that if he dies first, that farm doesn't go to the new spouse as opposed to Bob and his wife's original children? So life interests are a very important tool in planning. Ownership options and structures. We get a lot of questions about ownership. Should we own the land personally? Should we own it corporately? How do we structure that? Wills, enduring powers of attorney, and personal directives are important. Those are the underpinnings of the estate planning process. Life insurance is actually a very interesting area, and it's growing in importance. Life insurance it gives us the ability to make monthly premium payments and create a large pot of money, $1 million, $2 million, $3 million, to either pay off debt. That's an important facet of life insurance. And it's also important and growing more important in estate equalization strategies. So when a farm has more than one child, farm family has more than one child, a lot of times we'll use cash flow from the farm to provide life insurance benefits to equalize the estate to the other kids. So in Sue's case, She'll get the farm and perhaps the brother will get some life insurance proceeds. That helps with fair and equal. Credit, hugely important. Credit is often put in place to leave doors open for planning. We like to have the ability to borrow money when we need it. Sometimes it's better to get credit ahead of time as opposed to when you've got your back against the wall. And it gives us the ability to purchase more land, and it also gives family members the ability to buy out each other. And then again, other savings, and that's where McDougall comes in, the tax-free savings accounts, investments, RSPs, corporate savings, all of those things are very important. So these are the actual estate planning tools, and we'll use them to different degrees with each family. So when we look at your estate, what we do is we start from the bottom up. So we use the planning pyramid, Sam. On the bottom level, the will, enduring power of attorney, personal directives, they're the underpinning of everything that we do, and often shareholders' agreements. Those are the documents that outline the agreements in the succession plan that are important and facilitate the transfer. An emergency fund's important. Debt, a lot of farms will carry debt, so we need to make sure that the debt is manageable on the parent side and then also to the children's side. Here again, we often use life insurance to pay off debts in the event of premature death, disability, and sometimes we look at critical illness insurance in the case of involuntary separation. The next level is the home quarter. We look at the home quarter. There's some special tax rules for passing that to the next generation, half a hectare of land and the principal residence. Government benefits are important, and sometimes when we do our tax returns throughout our lifetime, we haven't been making contributions to Canada Pension Plan, and it's just an accident that you have it or don't have it at the end of the planning process. We like to address that straight up. Sometimes we are okay foregoing the benefit, and sometimes it's important to include it in the planning. Other savings, if there's excess cash flow from the farm, it's nice to have tax-free savings accounts, RRSPs, pensions. Some of us have off-farm pensions. In Bob's case, his wife was a nurse and she had a pension that provided them $2,800 a month. And then the land. And finally, our legacy, you know, charitable giving, trusts, trust planning. Sometimes we don't give land outright to beneficiaries. Sometimes we allow them the use of it during their lifetime and it passes through to the next generation. But none of the things that we do are without the process, without thought, and without careful step-by-step planning. So it doesn't happen in a day. It doesn't happen in 2 days. It's a process. It can take 5, 10, 15 years, and we're always updating the process. So, you know, Sam, I think we're going to finish early today. I wonder if there are any questions from the audience.
Good, thank you, Cori. Yes, we do have a few here, so I will just get started on them. Is it better to transfer our land to our sons now, or should we put everything in the will and wait until we die?
So that goes back to the need to understand what's important to your family, what are the points of vulnerability, and control. So if there are reasons not to pass the land to your kids in your lifetime, if there's unstable marriages, if there are other concerns, those have to be factored into the planning, and obviously that affects the outcome. And again, the only way we can make decisions like that is to help walk you through the process and make those determinations as we go through. So there's no easy answer to that. I can't answer it one way or the other. You know, it depends on your family situation.
Okay, thanks. So my daughter is taking over our family farm and recently married. Although their marriage seems to be going okay now, I do have my concerns. What kind of structure should we put in place to ensure if something were to happen, like a divorce, the farmland and everything stays intact with the family?
That goes back to the issue of control. You know, again, sometimes you can't pass the land over to the kids prematurely, you know, especially when there's concerns about marriages. And another area that's very helpful is trust planning. Assets can be placed in a trust, and family members can enjoy the use of the land. One of the interesting things about farmland is, even though Bob's net worth on paper is $5.5 million, Bob never really gets to enjoy that $5.5 million personally. He's just the custodian of the land. He's just the holder of the land. The land was passed to his wife by her family. Him and his wife enjoyed the life and made a living off of the land in their lifetime. And now Bob feels a huge responsibility to pass it on to his children. So that's the interesting thing about family land. And if the intention is to truly keep it in the family, in this situation with your daughter, you do have to put some of those tools in place to make sure that if there is a divorce or separation, the family ultimately, their children, the other children ultimately continue to enjoy the land.
Okay, thank you, Cori. Can I purchase life insurance on my parents and use the death benefit payments to buy out my siblings rather than borrow money from the bank and pay them out?
That's a very important exercise that we're doing more and more of these days. So when there aren't enough resources and one sibling has to take a loan to buy out the other sibling, that creates pressure on the cash flow of the farm. That can be very difficult to do, and it can ultimately lead to an unsuccessful operation. So in the case where family members are healthy, and again, it's all determined by health, life insurance isn't something that we can buy for every family. Sometimes health doesn't allow us or give us this option. But when life insurance is a good option, paying the premiums on a life insurance policy from the farm corporation or from cash flow from the farm can be very efficient. And what I mean by that is, you're putting dollars aside so that ultimately a tax-free death benefit flows into the estate at the time of death of one or both parents. That money is available to distribute tax-free to the next generation. So when one child gets the land and the other child or children don't get anything, this is a very, very tax efficient way to make sure that fairness and equalization are reached to a greater degree than an estate where we don't use life insurance.
And how, in terms of, you know, paying your insurance premiums, if you were to do that, how would you, what are the options in terms of funding your policy?